Thanks very much indeed, ladies and gentlemen. Thank you, Kath, for allowing me to be here. Actually, I don't have to go early. I have to go on time at 7 o'clock. Unfortunately, I have another engagement tonight, so I do have to leave at 7. I was told I was to be the moderator, but Kath also told me this morning I can talk for as long as I like. Everyone else is confined to 10 minutes of speech, but I can talk at great length. As you know, the subject tonight is the global financial crisis proves the free market is unreliable. We need more government intervention to grow New Zealand's economy. I'm not going to talk about the latter part of that book because I am also chairman of the 2025 task force, as some of you know, and we're going to have some recommendations on what the government should or should not be doing in our report when it comes out in November. But I will talk about the first part of the book, namely the global financial crisis proves the free market is unreliable. I'll let other speakers, of course, speak to the second part of the book, or indeed any part of the book they feel like talking to. It's become fashionable to blame the free market for the global financial crisis. In fact, as we talk, the G20 leaders are meeting in Pittsburgh, and among the things they're going to try and do is regulate the banking system better, restrict bonuses paid by banks to bankers, to restrict in some way the greedy and irresponsible members of the banking fraternity. It's taken almost axiomatic that the crisis has been caused by greedy and irresponsible bankers. I don't want to defend bankers because clearly there has been some grossly irresponsible behaviour on the part of bankers has been visible to all. The kind of behaviour where you can get paid 15, 20 million US dollars after you've caused your bank to collapse seems to me to be absolutely outrageous. But I do want to argue that the irresponsible behaviour of bankers occurred within a policy environment which actually encouraged irresponsible behaviour. And I can make 5 points. First one is that it's fairly clear now in retrospect that interest rates were too low for too long through much of the last decade. Now, in part, that was a mistake made by the Federal Reserve Bank of the United States, which kept short-term interest rates very low and encouraged very cheap lending by banks. In part, you could blame perhaps the Chinese authorities for keeping their currency undervalued, which generated enormous export surpluses from China, which the Chinese invested in US Treasury bonds, and that of course kept long-term interest rates low in the United States also. So low interest rates, which were clearly not directly the fault of the bankers, they were the fault of policymakers in the United States and other countries. The second policy failing, I think, on the part of governments, particularly the United States, was ongoing pressure on banks to lend to marginally creditworthy and indeed downright uncreditworthy borrowers. I want to quote a guy called Richard Salzman, who wrote an interesting article earlier this year. He said, the real problem is what he called the morality of altruism. He argued that, quote, altruism has motivated the utter debate of the past decade, highlighting the legal coercive backing of Washington's altruistic credit policies. The Federal Reserve Bank has for years distributed a booklet to mortgage lenders called Closing the Gap, a guide to equal opportunity lending, which includes sidebar reminders that fines and jail terms await those found to be deficient in fighting discrimination by not lending to the less than creditworthy. The booklet, still distributed today, this is, I'm still quoting from Salzman, derives as arbitrary and unreasonable such traditional credit standards as a 20% down payment, an above-par credit score, a history of paying one's bills on time, and a steady job yielding an income sufficient to make monthly mortgage payments. This was officially encouraged debasement of lending standards. The third phenomenon you see in the United States and not elsewhere is non-recourse lending. You probably all know what non-recourse lending is. The banks lend to a borrower secured by a mortgage. If the house price goes up, the borrower feels good. If If the house price goes down, the borrower simply walks away from the debt and has no further obligation to pay. They simply mail the keys back to the bank, in what in America is called jingle mail. Why that's done, I must say, in the United States is utterly beyond me. It used to be purely for the US. I've asked the American Federal Reserve people, is this a policy-driven thing, or is this some kind of response by banks to competitive behaviour? But in any case, I haven't been able to find the answer to that question. The fourth point was tight regulation of land suitable for residential subdivision. This is, of course, a phenomenon not peculiar to the United States. It's true in New Zealand, it's true in Australia, I'm sure in many parts of the English-speaking world. You have enthusiastic types like the Auckland Regional Council putting a tight ring around Auckland, and that's what happened in the United States. When you start getting increase in demand for housing, there's no capacity for supply to meet that increased demand, and what happens is the prices start rising, and that becomes self-perpetuating. In no time at all, you've got quite a bubble. Just as an aside, Arthur Grimes, who's now chairman of the Reserve Bank, did a study in Auckland, in which he discovered that the price of residential land just inside the metropolitan urban limit in Auckland was between 8 and 13 times the price of land just outside the metropolitan urban limit, depending whereabouts on the perimeter you were. Now, Thomas Sowell has pointed out that most of the mortgage foreclosures in the United States have taken place in 5 states. And those states are, I think, without qualification, states where there were very tight restrictions on the availability of residential land. So that was, again, clearly a policy-driven cause, in part, of the crisis. And finally, I'm going to blame highly intrusive banking regulation. You know, listening to people talk, you'd think there's been no banking regulation at all. There's a free market in banking. We're all totally unregulated. Brian Gould makes this point occasionally in the New Zealand Herald. There's nothing to be further from the truth. For 20 years, we've had Basel I, Basel II, and very intrusive banking regulation. I think banking regulation is a part of the problem. And it's part of the problem because it leads depositors to believe that banks will be bailed out by supervisors. And even more seriously, it leads bank directors to believe that too. I've never forgotten having a conversation with a man called Sir Peter Middleton, who had been head of the British Treasury for many years, and became director of Barclays Bank, and initially I think chairman of Barclays Bank. And I found myself sitting with someone at dinner. I said to him, Sir Peter, how do you find being a director of Barclays Bank after a career in UK Treasury? And he said, oh, it's surprising you asked that question. I thought that banking was about measuring and pricing risk, and I've had no experience of doing that. But he said, I was relieved to discover when I joined the Barclays Bank board that all I had to worry about was, are we complying with the Bank of England's rules? I think it's very serious. And let me quote the governor of the Bank of England, who, talking about the way in which banks have come to trade on the assumption that they will be too big to fail, he says, 40 years ago, the clearing banks in the UK held about 30% of their assets in short-term liquid instruments. Today, that liquid assets ratio is about 1%. For the major UK banks, almost 25% of customer loans are now funded by short-term borrowing in wholesale markets. At the turn of the new century, it was close to zero. I think there's a real sense in which intensive banking supervision has led depositors and bank directors to think that they will be bailed out. And we've seen the beginning of that happening in New Zealand. We don't have so much of it here. But at the moment, if the bank wants to appoint a new director or a CEO, or even a first report to the CEO, the Reserve Bank has to clear it. Now, if a bank really gets into trouble, and I was a depositor, I know where they're going to be bailed out. If the Reserve Bank approves every director, every CEO, and every first report, the Reserve Bank carries significant responsibility if the bank gets into trouble. So my proposition is, I'm not going to say what government intervention should do in the future, I'll leave that to my colleagues, but I would argue quite strongly that while there was a grossly irresponsible behaviour on the part of some bankers. The context in which they operated was seriously flawed government policies. That's for me. Thank you very much. B, C, okay. Peter.